Accounting for investments will vary depending on the level of ownership or the level of influence the investor has on the board of directors of the corporation. To review differences between issuing and purchasing stock, if you issue it, it's equity, but if you purchase it, that's an asset, usually a long-term asset. So if you issue stock, the corporation issuing it, it's the credit balance. If you invest in stock, we're talking about corporations investing in other corporations, it's an asset and it's a debit balance. Same with bonds. On the issuer side, it's a liability, and if it's sold at less or more than face value, there is that amortization or the discount or premium. On the investor side, it's an asset. Investors can invest in stocks or bonds. It's an asset, whether it's equity or debt. It's a debit balance, and there could also be an amortization required of the discount or premium. On the issuer side, if you recall, for bonds, the amortization is through interest expense. On the investor side, the amortization would be through interest revenue, but there will be a balance there. 4 times journal entries are required, no matter what the method. Purchasing it, recognizing investment revenue if interest or dividends are received. Holding the investment during periods when fair value fluctuates. So you still maintain historic costs, but with investments, when there lacks significant influence, it's important to also monitor fair value. So there will be fair market value adjustments to the accounts. And then, of course, selling the investment, removing it from the books and recording the cash that was received for the sale. So when we're talking levels of influence, you're thought to lack significant influence on the board of directors if you have less than 20% ownership. And if you have between 20 and 50, you're thought to have significant influence. And we're talking about influence directly on the board of directors. Think about the one important time when the declaration occurs. That's according to the board of directors. So if you have a lot of influence, you can influence when that occurs. And because of the unethical things that it can occur, different accounting rules apply if you have significant influence, if you own a large percentage of a corporation. Now, keep in mind, these numbers are approximate. In real life, you could have, let's say, 12%, but maybe you have a good working relationship with the board of directors, so you do have significant influence. And if you lack significant influence, you record it. The accounting rules are different than if you have significant influence. Another example, you could have, let's say, 35% ownership, but there's a bad relationship there. So even though you own a significant amount, if there's a bad relationship and you cannot influence the board of directors, you're required to account for it as if you lacked significant influence. And over 51%, that's controlling influence. That's when you have to consolidate. So, lack significant influence, the accounting rules are you have to use the fair value method. Investment classifications are required. This is also called the cost method. If you have significant influence, you're required to account for things using the equity method of accounting, which is different. If you have control, you have to consolidate. That is an advanced accounting topic, so just know the numbers. If it's over 50%, a consolidation is required. So what are these investment classifications if you lack significant influence? Well, there's trading securities available for sale. These both can be stock or bonds. You can invest in stock, you can invest in bonds, and if it's classified as trading or if it's classified as available for sale, you're required to do fair value adjustments. You still maintain historic cost in your records, but on your balance sheet it's recorded at its fair market value, and this is done through various fair market value adjustments. Just adjusting journal entries at the end of the year. The third classification is held to maturity. Stock does not mature, only bonds mature. So if your intent is to hold it until it matures, let's say you invest in a 20-year bond and your intent is to hold it for 20 years, you classify it as held to maturity and you do not do fair market value adjustments. It's simply recorded at traditional amortized costs, which means historic costs less a discount or plus the premium of what remains unamortized to date. And you can refer to your bonds chapter for a review. You're just on the investor side now, because remember, these are assets. No adjustments are allowed. That's the key to remember here. Trading and available, if you lack significant influence, you're required to do end-of-year fair value market adjustments. You'll keep a fair value adjustment account separate from the historic cost account. Fair value method, there will be 4 times when you will have to do journal entries. When you purchase it, when you recognize investment revenue, interest revenue, or dividend revenue. Holding the investment during periods when the fair value fluctuates, the end-of-year adjustments, and of course, selling the investment. Those are your journal entries. Now, the equity method, that's different. This is required if you cannot control, but you do have significant influence on management, on the board of directors. The equity method is thought to be a partial consolidation, sometimes called a one-line consolidation. You're treating that investment account as if it's one company. It's sort of a mirror effect, and how to do it will be discussed in a separate video. Again, 4 times when you will be required to do journal entries. The first one and the 4th one will be identical to the fair value method. Different accounting journal entries are done when using the equity method for the 2nd and 3rd here, recognizing revenue and fair value adjustments. You're not allowed to do fair value adjustments using the equity method. So these are the differences highlighted here between the equity method and the fair value method. The 1st and the 4th are identical journal entries. So back to the fair value method. If you recognize investment revenue on a stock investment, you record cash coming in. Investment revenue, that would be your dividends. For a bond, if you happen to be amortizing a discount, it's going to be cash, discount on bonds investment, and the adjustment will lower or increase investment revenue if you're amortizing a discount. Just as if on the issuer side, where interest expense is increased when you're amortizing a discount, revenue is increased on the investor side when you're amortizing the discount. So you're recording revenue when it's actually paid the dividends or interest. So this, you could actually say this is sort of like the cash basis. You're recording revenue when you receive the cash. The equity method is going to be different. Recognizing investment revenue. This happens before. This is not the same time as dividend distribution. This is when your company is recording net income. How do they record net income, or how do they close net income? It closes to their retained earnings. So the retained earnings of the company that is invested in is going up. So a mirror image on your side, your investment account, it's going to go up. This is what we mean by a one-line consolidation. You're recording the revenue when you earn it, not when you receive the dividends. Now let's say you do get dividends. What happens to retained earnings on the company side that you have invested in? Retained earnings dividends come out of retained earnings. So equity goes down. Mirror image on your investment account, your investment goes down. So notice the difference of when revenue is recorded and when cash comes in. This decrease in investment in stock represents a dividend that you received. This is dividend revenue. This is taxable earnings for your corporation. So just keep that in mind. The focus is, how do I do the journal entries differently? Another key to remember, investment in stock is not classified. If it's the fair value method, you're required to call it trading securities, available for sale, or held to maturity. If you're using the equity method, you do not classify it. It's just called investment in stock in a specific corporation or investment in bonds in a specific corporation. So the classifications. For trading securities, you have to do a fair value adjustment. It's recorded in net unrealized holdings, gains and losses, income statement. If it's available for sale, same type of fair value adjustment, only instead of recording it immediately to the income statement in earnings, it goes into a different earnings account called other comprehensive income. So a couple keys to remember here: unrealized as opposed to realized. If I sell it at a gain or a loss, it's a realized gains or loss. But a fair value adjustment, I have not sold it yet. So it's an unrealized gain or loss. And this is how we track fair value adjustments and still maintain a record of historic cost. Held to maturity, it's recorded at amortized cost. There are no fair value adjustments. Now this will be explained in detail in a separate video. The equity method, just remember, no fair value adjustments are allowed. Adjustments are required for depreciation and impairment, but that is more of an advanced accounting topic. So depending on when you are viewing this, this is an introductory principles course, you're just given a cursory review. If you are studying this in intermediate or later in advanced accounting, you will look more in depth into those depreciation and amortization adjustments to your account. So using the equity method, it's an asset, remember. Record initial cost, historic cost. Depreciation adjustment is a decrease to your stock investment. Share of net income is an increase to the stock account. Dividend distribution is a decrease to the stock account. And share of net loss, of course. If net income increases the stock value, then net loss is going to decrease it also. And this is the equity method.